Hello and welcome, everyone. For centuries, people have coveted this. Many have also invested in it and, of course, made lots of money. The question that we always ask ourselves about gold is this the right time to invest? Should I be thinking about gold as something beyond an ornament that adorns my spouse or me? Or can I actually do something where I develop a strategy and come up with something interesting, and therefore to do all the homework that one needs to do when you invest? So that's the big question, but let's try and answer it in a way that only an expert can perhaps answer. Today, I'm happy to introduce on Edge Insights and in Edge Insights, Hiren Chandaria, a commodity investment expert. So let me introduce Hiren to you first, and I'm going to then hand it over to him for a short presentation on gold. And then let's talk about what you could learn from it, and also take your questions on what you should be doing if you really want to understand how this precious metal behaves, has behaved, and will likely behave in future, if and particularly if you're interested in being involved with it in a significant way. So Hiren is based in London, has over 16 years of experience in commodity investing as a fund manager, trader, commodity business head, and product head in both UK and India. He has managed the largest gold fund with assets of over $500 million for Reliance Mutual Fund, Nippon India Mutual Fund. One fund managed by him was the best performing fund globally, outperforming 44 global funds as per Bloomberg Risk-less Returns ranking. Another fund, conceptualized, launched and managed by him, was awarded the most innovative fund of the year by CNBC. Now he designs contracts for a regulated exchange and has set up a new line of commodity business for a large NBFC. Hiren is a Sloan Fellow from the London Business School and a CFA charter holders. He also has been recognized by the UK government as an exceptional talent and UK Tier 1 Global Talent Visa. So this is Hiren, and let me, without any further ado, hand over to him for his presentation, post which I look forward to having a really interesting and insightful conversation. Hiren, it's over to you.
Hi, guys. Thank you very much for joining in. Hope you are having a lovely evening in India, way back everywhere else. Good morning, good evening, good afternoon, wherever you are. And I hope to bring some kind of thought. I intend to share my thought process in terms of gold investment, what I feel, why I feel it, and what are the dynamics in the gold investment markets, right? So let me share the presentation. As I told you, this presentation would give you a perspective on where gold prices were, why they were there, what is happening right now, and where they're going to go. I have never been a history buff myself, but what happens is history gives a very interesting perspective of things where they were and why they have moved here. And that would give a good idea of where they are going in future. And that's why I will be taking you through that regards. So gold keepers, is earning from gold possible? I think so. Let's see how. Okay, so first let's look at total gold mined till date. Now, if you put a total quantum of gold that is mined till date, it around 200,000 tons of gold, 2 lakh tons of gold, that amounts to around $12.2 trillion worth of gold. And that, in my opinion, is the limited quantum of gold that is available till date. Now, this gold has been increasing by around 1.7% per year throughout. I mean, this has been happening throughout last many years, and it's likely to happen going forward also. I don't think so there's anything likely to change on the supply side, and that's why we are going to add only this quantum of gold every year. In terms of demand is where we would be focusing on. And if you look at this slide, there are three main components which we would be talking about. First is jewelry, then official holdings, and private investments. Both these three factors, in my opinion, are important to understand the gold price movement. And we'll be talking about each one of them, where they are and what it is, why is it important. Now, before we dive into why each of this factor is important, let's look at the overall dynamics of the investment industry. The total global equity market cap is around $100 trillion. The debt market cap is around $280 trillion. Okay, so both of them put together is around $380 trillion. Out of that, gold is $12.2 trillion. But is it right to compare that investment market to the total quantum of gold? I don't think so. It's a completely different ball game. Why? Because if you look at it, 46% of the gold holdings lies in jewelry. Now, jewelry, if you look at it, not many people would sell jewelry. They generally change the form of the jewelry from old gold to new gold or new jewelry. That is what happens. Until and unless there is a very, very terrible time in the family and there is an untoward incident which has taken place, generally nobody sells jewelry. If you don't trust me, ask your better half. And you would probably, the lady of the house would tell you that she is not likely to sell the jewelry. It's in India is termed as a stridan, that is the women's wealth. So it's never ever touched. So I'm very, very unlikely that this gold of $5.7 trillion is ever going to come to the investment market. That leaves us with the remaining holding. And now going back to the main point, that out of 380 trillion of equity and debt, there's only 2 point. If you look at my cursor, you will see a 2.7 trillion worth of gold that is available for investment. That accounts for around 0.74% of the total investment holding that are parked in gold. That's super important for us, that this is the total quantum of gold that is available, and that's an investment compared to the equity market cap. If you look at most of the portfolio theories, they look at diversification of 2.5% to 5% to 7% to 10% or 15%, and that is nowhere near. So if that has to go up, imagine the kind of impact it would have on the gold prices. That becomes super important here, and that is the reason why we need to focus a on private investments and B on official holding. These are, in my opinion, the two major components which would drive the gold prices. Look at each of them one by one. Let's first look at the official holding. Now, if you look at official holding, central banks around the world hold a lot of quantum of gold. If you look at central banks like Russia, China, Turkey, Kazakhstan, India, Mexico, they have been slowly and gradually increasing their gold reserves. Just to put things into perspective, China was not disclosing its gold buying till say around 2004, and in 2004 suddenly they told that okay, they have increased the reserves from around 500 odd tons to 1500 odd tons, and now currently they are holding around 1900 odd tons, 950 odd tons of gold. So they gradually increase, they don't disclose, but they increase in fashion, and they have been increasing over a period of time. Now let's ask this question: why do central banks increase their reserves? Central banks increase their reserves in gold to safeguard or diversify their portfolio against various currency holding or currency fluctuation. The global central banks put together holds around 56% of their reserves in US dollar. Okay. And in various other currencies. They have very, very small component of reserves parked in gold, majority of countries, but in say Western economies like Switzerland and other European nations, they around 55% of the reserves are parked in gold. The one major exception has been UK, which is only around 13% of the reserves parked in gold. So these countries have that. Compare that with India, China, who has lower single-digit numbers of the reserves parked in gold. If China alone wants to move to 10% of its reserves in gold, they would eat away a couple of years of mine supply. And that is a quantum of impact this gold buying from central banks can have. So that, in my opinion, is very, very important. Now, you can imagine what is happening right now, right? None of the countries, I mean, everybody is in kind of, currency dominance. Look at China is trying for the same. US is trying to maintain its position as a global leader. You look at other countries, they are all trying to do something of that sort. So in a way, if they want to diversify away from the world reserve currencies, they have to park their reserves in gold. And that is happening slowly and gradually. It's not going to happen overnight, but it's going to happen slowly and gradually. What I mean, analogy which I want to portray here is that if you look at tectonic the plateaus underneath our Earth's surface, they move very slowly and gradually. And one fine day, they would rub off in such a fashion that you would have a volcano erupting. And that is a time gold prices will really shoot up. So that, in my opinion, is likely to happen in terms of central banks' gold holding. Okay. Now let's look at private investments. In private investments, we break them into two major components. One is bars and coins, and other is ETF. If you look at bars and coins constitute around $2.5 trillion, 40,600 odd tons, and that has been increasing slowly and gradually. you look at this number out here, the percentage change over last 10 years. What has happened in bars and coins over last 10 years? Slowly and gradually, the investment in bars and coins have increased from 29,000 tons to 40,620 tons, right? And that is a 40% increase over 10 years against the overall increase in the total gold of 19.6%. 40% has been contributed by bars and coins. Now, this becomes very, very important. What is happening here? In terms of bars and coins, if you look at it, the millennials, the new generations have started investing a lot more in bars and coins, extent that has been compensating the jewelry demand. So I expect jewelry demand to gradually, slowly go down a little by little, but they are yet going to be very positive. I mean, every year we would be consuming around a couple of thousands of tons of demand globally in terms of jewelry, but that's slowly and gradually starting to kind of go down. And that is compensated by increase in bars and coins demands. The next slide will show what is happening in each particular area over quarter by quarter over last 10 years, what has happened. Okay. So bars and coins, in my opinion, are increasing. They are likely to increase and they would impact the gold prices. The other factor is the ETFs. Now, if you look at it, ETF has increased by around 66.6%. Okay, the total holdings in ETF has increased by 66.6% in last 10 years. Still, they constitute only around 1.9. That is around 2% of the overall gold holdings are constituted in ETFs. Now, ETFs are a very, very important component. And I tell you why. Not only because there is a significant growth over last 10 years, but also because they are the driver of the prices. Now, ETF investors, barring, in the Western world, are one of the most sophisticated investors, and they do understand a little bit of macroeconomics. They understand inflation, they understand interest rates, where the economy is growing, or what is likely to happen, and that is why they invest. And they are one of the major determinants of gold prices. If you look at the correlation of ETF holdings vis-a-vis gold prices, you would see almost 98% plus correlation with the gold prices. So ETF is the single most driver of gold prices. The demand in ETF is single most important factor of gold prices, I would say that. Now, not only because ETFs are important, but because they have made a sensible estimate of where markets are going, and that is why people follow that. That's the other things. Now, let's look at the fabrication demand. Okay, what has been the other fabrication demand and unaccounted gold? So 12% of that is kind of technology related investments in terms of mini LEDs, memory chips, wireless 5G circuits, and that is where gold is lying, where you need probably 100% of connectivity. That is where gold is lying, and then 2.5% is not accounted for. So all in all, from this side, what I want to take home is that you have to find out what is the determinant of each particular factor. Where, if jewelry is increasing, what are the areas we should look at? Whether we should look at the Western world, whether we should look at India, whether we should look at China. I believe for jewelry, we need to look at India, China. For central banks holding, we need to look at central banks of emerging economies like India and China, who hold a little less component of gold. Russia holds a little less component of gold than the Western world, and where they are likely to go. So that is official sector. In terms of investments, bars and coins, you can look at countries like India, China, Turkey, Middle East, where there's a lot of buying of gold. Even the trend has caught up in Western world like UK, US. So that's important there. In terms of ETF, is purely Western world, which I would be focused on, and that would be purely based on the macroeconomics and the money flow and fundamentals that drive the prices. This is the message I want to drive home from this slide. Now let's move on to the next slide. This is a graphical representation of what has been changing quarter by quarter over last 10 years. So if you look at this chart, you will see jewelry is purple in color, technology red in color, okay, investments, and so on and so forth. And this golden line is the gold prices. Now, one thing is very, very sure that jewelry demand, though it has gone down, why is that gone down recently? Because of pandemic, there are a lot of shops which are closed. There are not many wedding festivals which are taking place, not engagement festivals which are taking place. People are a little afraid to go out, and there are very less point of sales available for buying jewelry. So that is why jewelry demand has gone down over the recent times. But I think that's likely to come back, and I'll give you my reason why. So I was trying to book holidays during the current pandemic when the lockdown ended in UK and probably in Middle East. There was no lockdown at that point of time, and there was nothing available at that point of time. Imagine, in the middle of pandemic, global pandemic, there was nothing available. People are ready to spend and they are waiting on the sidelines. As soon as the pandemic ends, there will be a lot of flux in the demand and people would go out and buy. There's a lot of pent up demand, so to say. So I believe similarly in jewelry also, there will be more number of weddings next year. There will be more demand for gold, and people have seen the power of holding gold over a period of time. And that is proving right in terms of pandemic and other things. So I think this is going to bounce back. So that's jewelry. If you look at technology, technology is more or less stable. I don't see so that's likely to change. There have been some reports around gold being used by other advanced technologies like to find out the better version of COVID test and all that. But I don't think so that's going to impact much. I mean, if it impacts, it might be very positive, but I am not seeing it happening anytime soon. And that's why I would say the technology demand would remain more or less same. It would gradually increase over a period of time, but that's not going to have a material impact on the gold prices. Okay. The third thing is we are talking about investment. Now, like jewelry, investment also to an extent is impacted by a point of sale because bars and coins are impacted there. And second is ETF. Now, what is happening? You see a lot of money has been fluxed into the system by the central banks. They have put in a lot of money around the world, and that has a very big significant positive impact on the global financial markets, including equities. Okay, so money is chasing the riskier assets, and that is why the focus on gold has been a little low. So that's very important to know that the focus is low right now, but that's likely to change over medium to long term. And that, in my opinion, would also drive gold prices in terms of investment. So ETFs and bars and coins, in despite the pandemic, bars and coin demand has been quite robust. In terms of central banks, obviously, because of the pandemic, their main objective is to get the economy back on track, and including Fed, including all the central banks around the world, have been very, very upfront about it, and they are pushing gold prices higher. They are pushing for accommodative monetary and fiscal policy. What does that mean? The interest rates are going to remain low. They're going to be money is going to be easily available to people, and they are going to invest in riskier assets. That's likely to happen. So I think their focus of central banks has been on stabilizing the economy and bringing it back to the growth track and building confidence among the investors rather than buying gold right now. So there are few central banks like Russia who has ended their gold buying program in March. I don't know what's going to happen going forward, but nonetheless, overall, central banks will continue to buy gold. That is what is likely to happen. Now, these are quarterly charts. So you need to add four of the charts together to get a picture on the annual demand, right? And if you do that, you would be doing away with the seasonal factors. Very important to understand this graphical representation of this demand, where it is coming from. Okay. Now, this slide is one of the most interesting slides I have, right? I've always been bombarded with questions, and that is, gold prices only perform during bad times. They generally don't perform during good times. And I beg to differ here with strong evidence from the data. Okay. So this is basically, if you look at these three charts, this green line is in Indian rupees. This maroon line is in Great Britain pound, and this bluish line is the USD, right? So if you look at this, you will see in 1980s, suddenly gold prices started picking up. And why have I taken only from 1970? Okay, before 1971, gold prices were packed to dollar. So they could not move freely, and every dollar was backed by a certain quantity of gold that was there. In 1971, President Nixon came in, he abolished the gold standards, the Bretton Woods II went out of the door, and that is when gold prices started shooting up. Now, from around $35 an ounce, in 10 years, it moved to $850 an ounce. That was in 1981. So imagine this is around 200 times. Okay, I repeat, 20,000 percentage, 10,000 percentage, 100 times increase in gold prices. So though this graph seems to be a little linear, its magnitude is kind of hidden because of the scales, right? So you can imagine $800+ an ounce in a span of 9 years or 10 years. That's a remarkable journey. Nobody talks about that, right? Even after that, From $850, it has been hovering around 250 to $350 an ounce for some time because of central banks' gold sales agreement. What used to happen is central banks had a mechanism by which they used to disclose that they are going to move out of the gold investment, and they used to make public announcement, and everybody know that they have a lot of muscle power or the gold to sell. Now what happens when you hear such a thing, that the biggest holder of gold is planning to sell gold, and that comes in the market a little a little over 1 month before they are going to do that? It would impact gold price. It would come down, right? And that's used to happen. Now that continued till say around 2000, and they had central banks gold sales agreement. They used to cap the total quantum of gold they can sell per year, all put together, and that all things used to happen. But in 2000, suddenly things started changing, and this central bank started buying a lot of gold, and that is why you see the major gold price rise has been happening since 2000, right? So irrespective of the fact that gold prices were stagnant for a certain period of time, they have been giving consistent returns, and that return has been in various currencies. Okay, so this chart shows here that the return in US dollars terms over 5 years, 10 years, 15 years, and various other periods has been quite good. 40 years has been a little lackluster, but if you look at all other periods, it's quite good. In pound sterling, it has been very, very good returns over various periods. In Indian terms, the gold prices returns have been very, very good. And why is that so? If you look at the Indian gold prices, there are two factors which have a positive impact on gold prices. Point number one is gold prices itself, and point number two is the rupee depreciation. Now, over a long term, rupee is likely to depreciate, and it has been depreciating since times immemorial. I tell you the reason why. See, if you look at the rupee chart, it would be going a straight slope. It would be straight going up, barring a couple of years like 2009 and 2004, and a few of the periods where rupee has appreciated. Otherwise, rupee has consistently depreciated. The reason for that is, if you look at interest rates and inflation, the interest rate and inflation is higher in India compared to the other Western economies. If interest rates and inflation are higher because of the purchasing power parity, rupee is likely to depreciate, and that has been happening over a period of time. So until and unless you are expecting that interest rates in India would be lower than interest rate outside India, in terms of Western economies, and inflation is going to be lower than the Western economies, I doubt we can make a strong case for rupee appreciation over a long period of time. There might be some period. You might have heard of something called a yen carry trade. In that period, what happens is rupee appreciated for a period of 5. People borrowed yen and gave it an interest in India and wanted to bring back rupee converted into yen and get it back to Japan. That really didn't happen. I have seen a few big corporates getting into a bigger mess because they anticipated the rupee is likely to appreciate. I don't think so that's going to happen anytime soon. Okay, so similarly, if you look at it, US dollar, pound, rupee, Chinese RMB, you would see that returns are not at all bad. Let's compare it to the returns in Nifty. If you compare the gold price return in Indian terms vis-a-vis the Nifty, which is a like-to-like comparison in my opinion, you would see that gold prices have performed quite well in most of the period. In few of the periods, you will see, like for example, 30 years period, you will see a slight advantage Nifty has. But that is again coming from a very, very lower ground. So I would say gold prices have consistently given good returns over a long period of time. And we are talking about a period of 40 years, 30 years, 25 years, right? This is in my opinion, quite a long period. 40 years back, we don't even know. Nifty didn't even exist, right? So these are the things which I'm talking about. So point to drive home from this slide is gold prices have consistently performed better over a long period of time. Yes, there would be some period in between when gold prices may not perform good, but over a long period of time, they tend to perform good. Okay. Now this is a graphical representation of the annualized return of gold vis-a-vis other markets. Look at markets like US cash, that is this, gold prices, then you have commodities, you have stocks and emerging market stocks and all that, right? So you see over various period, since 1971, gold has been one of the top performers. Similarly, over 20 years, gold has been one of the very good performers, only second to the emerging market equities. So similarly, gold has consistently given good returns. Now let's look at what happens to gold prices when other markets are not doing well. Okay, so this right hand side chart, you will clearly see that this green line is the volatility index. It talks about the overall volatility, VIX index, what we call in the market, right? That goes very high when markets go bad. I mean, there's something which has happened, like it's a Black Monday or long-term capital market crisis, dot-com bubble, 9/11, 2002 recession, Great Recession. You talk about sovereign debt crisis, one or two, or anything, right? So you generally see that VIX index is very high and gold prices are very high. I mean, they have given a decent performance. And mind you, look at this returns in terms of 0 to 60%. So even this is around 10% plus return, right? So this kind of proves that. Now, why is that so? See, the factors that affect gold prices are different than factors that affect other financial markets. Okay, they are different and they impact also in a different fashion. For example, tomorrow, if a war goes out, what happens? You see crude oil going high, you see gold prices going high, you see VIX index going high, you see equity markets tanking. So this is one scenario. Second scenario is you see that inflation goes up. Okay, because of the kind of money that is pumped into the system, if inflation goes up, what happens is the gold prices tend to move higher. Okay, and not necessarily equity markets would perform better. The third scenario is world is a safer place to be in. There is no crisis, there is no fear of war, there is nothing going on. Then what would happen is equity would go up and real estate would go up and gold probably would not perform. So that is why portfolio allocation and gold, looked at it from a portfolio perspective, is very important. So that is what I'm talking about. To summarize, the factors that affect gold prices affect other asset classes in a different fashion. So that is why gold acts as an excellent portfolio diversifier. Okay. Now let's look at other factors that drive gold prices. For example, inflation. Okay. How do we talk of inflation? Okay, forget about numbers, what we are talking about, forget about negative interest rates and all that. Let's look at it from a very, very layman's point of view. Inflation is nothing but the price going up for your monthly annual expenses, right? Monthly or annual expenses, whatever it is. So if you have 10 grams of gold, okay, that 10 grams of gold, if you sell it and you buy the commodities and pay your bills, rent, everything for 1 month, you should be able to suffice. Now, this has been true centuries back, 50 years back, 100 years back, 400 years back, and probably next 500 years afterwards also, we'll be talking about the same thing. So for every 10 gram of gold, if you sell it today and you buy 1 month of consumables, your food, your groceries, your electricity bill, your everything, then it should suffice. If you move to other economies like Western economies where the prices are a little higher, probably it is 1 ounce, right? That is around 31 grams. That would suffice. So that, in my term, is the inflation. That is the inflation from my perspective or from a layman's perspective, that gold is a good hedge against inflation. Similarly, interest rates. Now, what happens? If interest rates are lower, then what? The opportunity cost of holding gold goes lower, and that is why generally you see when interest rates go lower, gold prices tend to perform better. When interest rate is higher, again it's a very strong indication that inflation is higher, and that is why gold prices tend to be going either way. It can go up also, it can go down also, but when interest rates go down, generally gold prices go up. Third is the consumer sentiments. If consumer sentiments are pretty low, people are a little afraid of spending. What is happening right now? People are a little skeptical of spending. The rich are getting richer, the poorer are, and people who are hand to mouth are kind of holding back their purchases. And that is whereby what I mean by consumer sentiments. But at the same time, the richer people who are investing in equity markets, their sentiments are bullish and they are investing very heavily in equity markets, and that's why you see most of the equity markets going very, very high, right? In terms of disposable income, what is the income that is left after you account for your monthly grocery bills and everything, right? Or annual grocery bills and everything. That is your disposable income. If that is high, you tend to focus on portfolio allocation and everything. So that's other thing. Um, the fifth thing is risk perception. What is your perception of risk? Do you think the world is going to be a safer place in 2024, 2025, 2026? Do you think China issue would die down? Do you think South China Sea would die down? Do you think Afghanistan, Iran, everything would be a safer place? There would be no Israel, there would be no hacking attacks, nothing like that. So then probably gold may not perform that well because of risk perspective. Because of other factors, yeah, it would do. Then other see, color of money is the change, right? So sixth factor I am talking about is the performance of other financial markets. Now, what is performance of other financial markets? If you are seeing a greater returns in equity markets, then probably people would move away from gold and invest in equity markets. If you are seeing better returns in real estate, then people would go there. So that is also an important factor to consider. And lastly, what I would talk about is the tail risk. What is tail risk? Tail risk is the rare event like pandemic, like war, which are happening right now. How does that impact gold prices? Looking at currency impact, US dollar and INR. These are the two important factors from the Indian perspective, right? So, in my opinion, currency, as I stated before, is likely to depreciate over a long period of time. And if currency depreciate, it makes gold more pricier for the non-US investors. So what happens is if gold prices remain the same, but if rupee depreciates, then gold moves higher. And that in a way hedges your currency risk to an extent as a country, right? As an individual, if your rupee is depreciating, it's bad for the country. But if you have gold prices, then your portfolio or your investments would go a little higher. We talked at length about central banks gold buying. We talked about geopolitical. We talked about Cold War. We talked about pandemic and risk aversion. So I think suffices to say we have to consider all these factors cumulatively rather than standalone to understand where the gold prices are going, right? And now let's look at what are the best ways to buy gold. In my opinion, the best way to buy gold is for Indian investors is a sovereign gold bond scheme. And why do I say so? I have my reasons. A is it pays you around 2.5% interest. So cumulatively over an 8-year period, it constitutes to around 27% of return. Now these are pre-tax returns, but imagine that this is paid every 6 months biannually, right? So every 6 months you receive 1.25%, and that 1.25% can be easily deployed at around 4%, 6%, depending on the bank which you are banking with, in a fixed deposit or in a savings account. Imagine that. So the returns would be much higher. And even if you pay taxes on there, you are protected. So what does that mean? So suppose you invest at a gold price of 100, and if gold price is correct to say 80, then also you are better off because you have earned a little more from the interest, right? So that, in my opinion, is a very, very positive thing. Other advantages, there is no capital gain on maturity. So if you have invested in sovereign gold bond schemes, and if the prices have moved up by 500%, 200%, 300%, then you don't pay any capital gain tax on that. That is another important thing. The third thing is that generally you don't pay a premium over it. So if you are investing in gold prices, typically you will get a discount, say of around 50 rupees and gram or something when you buy it from a bank, right? A gold price, sovereign gold bonds bought from a bank. So these are the positives. The major negative of the scheme is that it's designed for retail investors and there is a lock-in. Now that lock-in is to the tune of 5 to 8 years. You cannot move out of this market before 5 to 8 years. There are ways of doing it. You pay capital gain tax, you move it, but it's as good as it's the option does not exist. So if you're looking for liquidity, probably sovereign gold bonds are not the right way of investing for you. If you are looking, for liquidity, then or you want to do dollar cost averaging or SIP and you want transparency in terms of the markets and where they are going, then I believe ETFs and savings fund are the best way to invest. The negative part about it is expenses. If you look at the expenses, you would be paying, even if you're paying an expense of say 1.5%, and if you invest over say 25 years period, every month if you invest just 1,000, then at the end of 25 years, your returns would be lower by around 3 lakhs. I repeat, by around 3 lakhs with just 1,000 SIP. If the market is growing at around 10 to 12%, and the expense is only 1.5%, you would be poorer by around 3 lakhs in a span of 25 years, just because of that 1.5%. So that is what I mean by expenses. And that is positive for sovereign gold, but ETF is the second best option still. The other options are digital gold, where you talk about prices, you talk about physical delivery, you talk about taxation. You have to find out from each particular operator where what is it, and what is the physical delivery, what are the prices, how they compare to the market, what are the taxations there, what happens to the VAT you pay. You pay around 3% of VAT, and what happens to that? I mean, you get, as a retail investor, do you get back that VAT? I don't think so, because we are not VAT registered, and we lose around 3% as a retail investor. Do we want to do that? So that is the question you need to ask. Again, in digital gold, you also need to take care that, well, the gold is held. If the gold is held with one of the government agencies, it's good. If it's not held with one of the government agencies, it's held with somebody else, then it raises some questions. So you need to ask that. In terms of physical gold, the reference price is a different thing. I will be coming that in the next slide. The reference price, the selling price, you do not have the option to sell it at a good price. Typically, a person who would be buying jewelry, and if he goes and sells at the same price, for example, gold prices are, say, X right now, you go and buy, and after a couple of days, even if the gold prices are X, you want to sell it back, and typically the range is between 30 to 40% of your investment gets wiped out because of various reasons, and that happens. So selling gold jewelry is not the best option. There are mechanisms by which people say, jewelers say, that they are able to do that because you buy a new jewelry from them and stuff like that. But typically, this has been the observation. The VAT treatment, you don't, you need to account for VAT, you need to account for various other taxes, and you don't get that back. When you are buying jewelry, one needs to be careful that you buy hallmark jewelry. And even if you buy a hallmark jewelry, everything should be hallmark. Like, for example, if you buy a pair of bangle, both the bangles should be hallmarked. One bangle being hallmarked is not good enough. Both of them need to be hallmarked. I'm not saying it's a 100% foolproof method, but it's a very good method. In terms of derivatives and mining companies, I have my reservations. That's a different kind of investment. I don't believe that goes along with the investment in gold. It's completely a different kind of investment, because there are factors which affect any of the companies, like the management, like the place where it's located, what is happening, that does affect mining companies. It does not affect gold, but that affects a mining company. And this is the last slide in my presentation, where I'm talking about the gold myths. So we have talked about most of these things, like gold only performs during bad times. We discussed in detail. I don't think so. Gold only performs during bad times. It tends to perform during good times as well. If you look at 1980s to 2000, what was it? From 2000 to 2007, equity markets were up, gold was up. 1980 to 2000, both were up. Okay, 2007 to 9. Both corrected a little, and then gold market went up, equity market went up. Again, they both are going up. So there you see this happening time and again. Okay, gold has a meaningful correlation with US dollar and commodities. If you look at the statistical numbers, gold does not have a significant correlation with either of this asset class. What I mean by significant is that anything about 60 or 70% of correlation is a good. 0.6 or 0.7 plus correlation is termed as good correlation, and that would be meaningful. However, they don't have it. There are different factors that drive gold prices, not only US dollar and commodities, and that is why you see they don't have a strong correlation. Gold in jewelry, ease of selling at a reasonable price, it's difficult. I mean, gold is generally not sold at a reasonable price. You lose around 30-40% of your value if you sell it. Okay, gold spot prices are equal to futures price on exchange? I don't think so. Futures price are traded on the spot price. They are derived by adding in the cost of carry, then there is also impact cost and other things which leads to that. And if you want to trade in the futures market, then typically what happens is you will be paying short-term capital gain tax. Now, because of these particular reasons, I think gold prices on futures exchange are completely different from the spot prices. And carrying on that point, if you have the spot price gold, then you can derive the price for 916 gold. That is 22 karat gold, which we normally call it. Again, we talked about it. Gold futures are not a good way to invest in gold. I don't think so. Governments around the world are selling gold. I don't think so. We discussed that. paying a small annual percentage of buying gold has a very little impact on long-term returns. We discussed that, right? Only 1.5% if you're paying on SIP of 1,000 with annual returns of around 10 to 12%, then you are losing around 3 lakhs over a period of 25 years. So these are the things I believe. And thank you.
Thanks, Hiren. Before I come to those questions, a couple of quick ones, Hiren. Would you say gold is meant for sophisticated investors? And I'm not talking about physical gold, but I'm talking about sovereign gold bonds, exchange traded funds, and so on.
Not at all. I mean, gold is government has designed it for local people. I mean, for people like me and you. I'm sorry, not you, but a simple person like me. In terms of, you look at it, it's designed in such a beautiful fashion. You have a cap of 4 kgs. You can't sell it for 8 years. So it's not for the sophisticated investor. It's for normal investors. So I would say it's for everybody.
Right. So and therefore, those who want to invest in gold, and I'll come to the how much you should allocate and so on, should do it because it should be a part of their regular portfolio, not because they're venturing into something new and brave and so on.
So I don't think so. Gold is an investment which should be looked at in a standalone fashion. It should be looked at as a part of portfolio. And ideal allocation, I would say, would be around 7.5% to 10%. Given the certain times, I would tend towards higher portfolio allocation in gold, because I find it very difficult in the next 5, 10, 15 years. There's nothing going to happen with China, nothing's going to happen with US, nothing is going to happen with Euro. So it's very difficult for me to digest Afghanistan, Iraq, Saudi. There are n number of moving variables which can result in geopolitical unrest, and that would lead to higher gold prices in next 5, 10 years.
Right. And you've touched upon it somewhat, but what has the last 1 year taught you? For instance, in equity, it's very clear. The markets crashed through the floor in March, and then they went up 95% or plus in all over the world. Right. So, and that is something that no one predicted the way down and no one predicted the way up. Did gold do anything similar? And if so, were you in any way prepared for it?
So see, gold markets performed, it's corrected. Gold markets have corrected. And the reason being that what I've observed is that any impact on jewelry translates into international gold prices. And that typically happens because of whatever is happening during pandemics. The shops were closed. It was difficult to buy gold. There are no festivals. There are no weddings. There are no engagements. Ceremonies happening. So there is less demand of gold, and that has translated into that. Besides that, what has also happened is there is a major component when interest rates have gone down globally. If you look at most of the interest rates globally have been in the negative territory. In negative interest rate environment, and people are very confident, and including me, I have been a skeptic in terms of, government should not support equity markets like they do. But I'm of the opinion because of this pandemic, because of the widespread thing, they should support. And they have gone all out. If you look at the Fed policies, decisions, and you look at any of the governments, around the world, they are going to have accommodating monetary and fiscal policies. What that means is interest rates are going to remain low, and that would result in higher equity markets, in higher other riskier assets. And that to an extent would also result in gold prices moving higher over a medium term. I would say it would have its repercussions for the gold price over short term, but over medium to long term, it would be very, very positive because inflation would come back.
Right. So you talked about the total stock of gold, and that's a very interesting number. You said 200,000 tons worth $12 trillion in contrast to equity, which is $100 trillion plus. And the stock is only rising by about 1.7% every year. Right. So in a way, there is a cap on demand. Unlike equity, let's say 5 companies, big companies launch IPOs, Chinese companies, American companies, Indian companies. So the supply can shift dramatically off paper. Whereas in gold, everything is predictable. In a predictable environment, it's a very theoretical academic question, why would prices go up in a way that you can't predict them? And why wouldn't they just be where they are most of the time?
Okay, so because of a couple of reasons. See, gold, unlike most of the assets, for example, if you look at silver, if you look at crypto, if you look at any other assets, right, what happens is they have single utility. Gold is a multi-utility. It has been in existence even before equity markets were, even before everything was, right? So one is medium of exchange, it is store of value, it's the portfolio diversifier, right? N number of things. Now, even though the supply is almost predictable, demand is a factor which changes. And in demand, you look at jewelry, we know more or less it's going to be there. So that's why I was focusing on only 2-3 areas in demand which are likely to change. And that is what drives the prices.
Right.
And other way of looking at it is gold is not a consumable, right? Neither you and me, I mean, jokes apart in terms of Sona Chandni Chavan Pras, right? There is no other way you can consume gold. It's the total quantum of gold is going to remain somehow or the other, right? So it's derived by the demand.
Right. And tell me about that. And I'm going to come to questions from the audience. There are some really good ones. So where is that 14%, which you said is unaccounted? Is it with some people we know or?
Okay. So again, this is a very interesting thing. Around 12% of that lies with technology. In technology, in terms of, where you need 100% connectivity, where there is zero scope of error, aeroplane engines, where, connection has to be there, the engine has to start. Where you nowadays, even in 3D sensor opening a phone, right? Such kind of things, it's cables, all in technology. Yeah. You look at water purification, couple of n number of implications, and that's where 12% is lying. 2.4% we don't know. And I'm 100% sure if you look at India, China, then we would have much. I mean, numbers would twitch a lot, right? I mean, this is what official numbers are.
Okay. Got it. So let's take a question. And you did speak about Bitcoin. So Juzar Mustan asks, will gold lose some of its investment luster due to the impact of cryptocurrencies like Bitcoin? Since that's a new asset class, so to speak.
Yes. So I mean, I would say gold and crypto are completely coming from a different thing. One is like, comparing somebody like Sachin Tendulkar to somebody from gully cricket who has scored 100 runs, right? They are two different asset classes. If you look at crypto, it's been designed in such a fashion that till 2040, there would be 2 million Bitcoins mined, and then they would not be mined. But I may ask, I mean, who is it determining that? Who is determining that, right? That's one. So in my opinion, the supplies, though it's said it's limited, I don't know what it is. Look at the fluctuation in cryptocurrencies. They have been moving like crazy in terms of up, down, sideways, right? It's a flavor of the day, so to say. I mean, look at it, Indian songs, right? Most of us would be liking Indian songs like Jagjit Singh and all. I mean, they are class apart. You like them throughout the ages. And then sometimes some other song, pop song would come. It would be a highlight for 1 month, and then you forget it. So I don't think so. I mean, I don't think so that's going to happen. And none of the central banks are going to buy gold. None of cryptocurrencies. None of the governments are going to support that. I mean, not anybody is supporting, right? Even if they do, not many. So I think it's a completely different ball game.
And surely you can't make jewelry out of it. Okay, let's pick up another one. Rajesh Dalal asks, does America have an official holding as reserved? If no, what other countries follow this?
Okay, so thanks for that question. That's a very interesting question, because see, if you look at it, US holds around 8,134 tons of gold. That is highest in the world. The second highest is around 2,000 tons of gold to 2,500 tons of gold. Okay, now if you look at that gold priced in their reserve asset, you will see the average price of around $3 an ounce, something of that sort, $3 or $35 an ounce. Okay, because they have been bought historically before 1971 and 1930s during World War II and all that, right? 1 and 2. And so they do hold a lot of gold. And US per se, I mean, on the other hand, US has to hold gold because it's the world reserve currency. If they don't hold gold, what will they hold? They would have to hold yuan, they would have to hold pound, which is not in their best interest. So they typically have to hold gold, and they continue to do so. US has not moved away from. Right. I mean, since 1971, they have never ever touched their gold reserves. That's my understanding.
Okay, that's a good data point to remember. Sanjay Mehdudia asks, and you've already answered this, but how good is investment or are investments in sovereign gold bonds?
I think it's one of the best form of investment, in my opinion. I mean, see, if you're investing at a gold price, assuming the gold is 100 right now, and if you're investing right now, if you are on a normal tax bracket, even if gold moves to 80, then also you are better off just because of the interest rate. And consider that you are getting interest every 6 months. So that 1.25% interest every 6 months, you can easily park in a fixed deposit at 4%, 6%, whichever bank you are going through. So it adds a lot more, and you would be comfortable even if the price is correct to around 70% or something. You are still breaking even. There is no other form of investment which will give you that luxury. So
okay, right. Here is a question. Which even I've wondered. Ajay Bakrania asked, why do ETF returns differ when they all invest in gold, or in the same thing? Is what he's asking.
Okay, so ETFs. What happens is, see, this is one way how they take away the cost, right? ETF, when you invest in ETF, if you're investing 100, right? If you're investing 100 in ETF, then 1% moves out of that every year because of the annual expenses, whatever is the expenses, right? 1%, 1.5%, or 0.5%, whatever it is. So that has to move on. They are not asking you for additional money. What they are doing is they are selling a portion of your gold and doing away, taking their management fees. So it goes down. Now, depending on when each of the ETF has been launched, they have different values.
So are you saying that's one reason why you're recommending a sovereign bond, because of the cost?
Yes, that is one major reasons I am recommending.
Okay, major reason. That's another important point to note. Savan Nathwani asks, what percentage of one's portfolio would you recommend gold for a 35-year-old? So I don't know, when you said 10%, you were thinking of 35 or 55, but go ahead.
Okay, so I would say if you are 35 years old, I would say around 7 to 10%.
Okay, and would that change as you get older, or you feel that at all ages you should be holding at that level?
I think it should move higher as you grow, because what happens is your appetite for risk would definitely come down as you move higher, especially during retirement. If you're earning more, nothing like it. But as soon as you're, you start eating up on your savings, you should start moving towards safer assets like gold and fixed deposits, stuff like that. Right now, it might be a good idea to invest a little in equities.
Okay. Nishant Maheshwari asks, and I think he's going back to the table you showed, Hiren, is gold really comparable with Nifty, since Nifty keeps on balancing from time to time on account of changes in the index?
So I would say gold has, I won't take away the credit of gold. At the same time, Nifty, because it's rebalancing, it's kind of survival bias. It has survival bias. There are many stocks which, most of the global index, if you look at it, not everything which was there 20 years back is still there, right? It moves, it recomposes, right? So the bad stocks keep moving out and good stocks keep coming out. Irrespective of that fact, gold has performed so better. Ideally, gold, it's an exaggerated return from Nifty from that point of view, right?
Okay. Harsh Mirani asks, is it a good time to invest in gold PMS who invest in mining companies, because mining companies are currently trading at cheap valuations?
Yes. So see, again, I would say if your focus is in terms of the gold as a diversifier for your portfolio, I would say mining is a different asset class altogether. It's a different animal. The reason being, mining is again impacted by geological, if you look at most of the mines where they are mined, okay, right now it's like major mining country is China, then you have Africa, US, Mexico, okay, all these areas. Now Russia. So what happens is the factors which affect any company do affect mining companies as well. The management, how it's been managed, what is the hedging procedure. If you look at hedging, most of the companies would have hedged their sales forward. So even if the gold prices move higher, they do not tend to benefit out of higher gold prices for a sustainable period. And that is why gold as a pure investment, in my opinion, is a better asset.
Okay, so go to as close to source as possible. Can gold companies be a proxy to gold as an investment hedge?
So I think the answer remains the same. I don't think so, because what happens in the mining company. Sorry, I'm getting into a little detail. I try to be as quick as possible. If you come up with, first and foremost, you prospect. You find out what is the gold reserves. You go with US or Australian authorities and try to find out what is the reasonable estimates, right? As soon as you do that, you need fund. And to need that fund, you need to project, you need to forward sell. You need funds, right? You project, you get the funding, you start mining. As soon as you mine, you start selling forward. That, okay, today I will sell 10 years down the line, supplies for 10 years at so and so cost. So your price is capped. If the gold prices move up above that, you do not benefit out of it. So I think that is one thing. However, that's a leverage play. Mining companies are a leverage play. It's not I would say it's a completely different animal. So they are two different aspects altogether. But lack of time, I cannot get into much more details. But I think it's completely different. I would not say it's a proxy.
Okay, Vidyut Kapoor asks, do gold ETFs in India actually hold physical gold to back up the units issued?
See, one thing I'm super confident about is in India, it's very, very difficult to do anything wrong as long as SEBI is involved. Okay. I would say they urge on the side of caution, and at times they go overboard and make it so suffocating that so many people, so many things go out the other way, right? So I don't think so. None of the gold funds, at least governed by SEBI, you have anything to worry about. There are regular audits been done. Gold is kept in custody of players like Brinks and Deutsche Bank, and even if anything goes wrong with any of these players, the gold is lying in your name. So don't worry about it. Nothing is. I am not at all worried.
Okay, that's a good point, which leads up to the next question. Then Rishikesh Upadhyay asks, then why are sovereign or ETF gold formats not considered for a loan?
So that is something you need to ask somebody who is providing you a loan.
Yeah.
Okay. Sorry, they should be considered for loan in my opinion. But I mean, frankly speaking, it's somebody else's money. I have no authority to dictate terms.
Okay, but you feel logically or conceptually, there's no reason why it shouldn't, because it's as solid as the physical aspect. Okay. Maybe someone else can answer that question. Tarun Vij asks, interesting question. How much gold is left to be mined in the world?
Okay, so gold, see there currently the prospect is around 50,000 tons of gold, which is visible. But frankly speaking, that's not, in my opinion, that's not a consideration which we should worry about, because over a period of time, what has happened is there have been new mines coming up, new prospecting happening, new gold reserves being identified. And as the price keep inching up, then we would keep finding out new sources of gold. Just an interesting fact out here is, if you mine 1 ton of gold, 1 ton of mud, 1,000 ton of mud, you get around 4 grams of gold in a good mine. 4 grams of gold. So that is the thing. So that's why you have a lot of ecological factors also associated with that. Sorry.
Right. So, but then because of that, could we actually see a reduction in output?
I don't think so, because as and when the prices go up, you will have new news and technology improves, new mines would come. The gold which is not available right now, you cannot mine because of the current technology and current prices, that would come. Like, for example, all-in sustenance cost right now is around $1,500 an ounce, right? So if gold prices are higher than that, 90%, I'm talking about 90%, right? We generally talk about 90%. So all-in sustenance cost is there. So that makes it much more feasible. If gold prices move higher, a little more reserves would be available. So that's not something which worries me at this point of time. Maybe 10 years down the lane, things might be different.
Okay, but environmental considerations, or ESG, as we think of in other extractive industries, is something to keep in mind. Dharmik Kumar asks, regarding interest rates driving gold, is there any reason why gold and silver fall as negative interest rates propagated through Europe over a period of about 3 years, but when Japan adopted negative interest rates, gold and silver took off?
See, I mean, there are so many things surrounding it, right? It's difficult to summarize this answer, but in a nutshell, there is no one-to-one correlation. If you look at it, debt to GDP, okay? Globally, we are talking about debt to GDP, negative interest rates. They have one particular aspect, but that's not the only answer for gold prices. Not necessarily that would provide a single answer, but yes, if the interest rates go down, the opportunity cost of holding gold comes down, and that is why gold generally tends to perform better.
Okay, so Hiren, there are a lot of questions in and around Bitcoin again. Okay, so I tried to compress a few, but let me pick up another one. Pareen asks, I've read multiple articles on Bitcoin being the store of value going forward. Is Bitcoin a threat to gold?
I don't think so, because tell me a number of governments who have supported the Bitcoin. I am the one who believe the power of government is above all, and they have tremendous powers. Such Bitcoins, this is not the first time I'm coming through this. This has been historically, there are phases, and it's like a wave structure. After some years, again it would come, then again it would die down, then again it would come. If you look at any of the numbers, you would be surprised at kind of volatility it brings to the portfolio. You would be surprised at the kind of returns it gives. I mean, it would give you 20x returns, and then tomorrow, after some time, it would wipe out 100% of your returns, right? So
Right.
it's a completely different story. No, I am not worried.
Okay. Dinesh asked, how do you check prices of physical gold over online prices, as each retailer has a different price, has his own price, which is different from what we see online? Is there any ratio?
So see, there is no ratio as such. If you look at it, let me give an anecdotal example. Lighten up the mood little. You have puchkas in India, right? Pani puris right? So after every sixth puri, you get one free, right? So similarly, in gold market, what happens is when you buy a gold jewelry, you buy 916 particles of gold, that is 22 carats out of 24, and rest of the things are copper, mineral, whatever it is, that's free. Nobody charges for that, right? It's like the free puchka, right? And the price of gold ideally should be the price of 995 grams of gold into 916. For 915, X is the price. So for 916, what is the price? That should be the price. However, you incur cost for the jeweler, his shop, everything else. It keeps on adding up.
Right. Okay. So, there are a couple of questions on outlook and both the immediate outlook as well as the very long-term outlooks, that's 20, 30 years. And I'm going to come to that in a second, Hiren. But, let me ask you, as in you've invested in gold and obviously are invested as a profession, as a fund manager, as well as I'm sure maybe you've taken individual positions. What's the biggest mistake that you've made? Or when do you think you misjudged?
The biggest mistakes, I believe, is to hear markets rumors. Don't follow your systems. In terms of if you decided I'll buy 1 gram per year, I should stick to it. If I have decided I buy 1,000 rupees worth of gold, I should stick to it. Not many people do that. I also made mistakes in my tenure, and I think everybody does. So if you are most of the 90% of your investments are determined by the sector allocation, where you allocate money rather than timing the market, right? Most of the big guys make 50% of their calls are wrong, 50% are right, and that are good enough to earn them fortunes worth billions, right? So don't go for picking down the bottoms every time. I don't remember anybody who has done that efficiently over a sustainable period of time. It comes,
right.
Be natural. Ideally you should invest in a pyramid fashion. In terms of if you want to start investing, start investing with 20% of your portfolio, whatever you are targeting, 20% of that right now, and then keep accumulating over a period of time. It can be either price corrections, or it can be either periodics, every month, every this thing, every Akshatrika,
right.
every Dhanteras, something of that sort.
Right. And I'm going to come to outlook in a second. Kulvinder Singh asks, from which country should we purchase gold?
Yeah, which Kulvinder Singh, there are, I believe, little options available for people to buy gold any other location, because physical storage is a challenge. If you want to buy gold, I would say buy it from any places which has low tax remedy.
Okay. Okay, great. So let me then come to the outlook. So there are 2 or 3 questions. Parag Patel asks about the next 3 or 4 decades. Karthik asks about short-term outlook, particularly with the US economy reviving, and you have talked about the influence of the dollar. So tell us, Hiren, as we close in the next few minutes, what's your short-term outlook? What's your long-term outlook? And what would you like to leave everyone who's watching today with?
So I feel over next 6 months to 12 months, precisely next 6 months or something, gold prices is going to remain a little volatile. In my opinion, it will be a good time to accumulate gold. Over medium term, I think gold prices will start going up, and before you know it, there would be some spikes where gold prices would have moved a couple of percentages, 10-15% higher. So that's pretty much possible. With terms of US economy and how it's shaping up, you see everybody is. I'll just give a data point, right? The world is closed down right now, most of the countries. When lockdowns ended, we were not able to find a hotel available in UK, outskirts of UK. We were not able to find any holiday availabilities. destination availabilities in Dubai, which were open at that point of time. So I'm saying people are just waiting on the sideline for pandemic to end. Not many are worried about the money they are spending. They have a lot of purchasing power. Government has influenced a lot of, in fact, barring, I know India, it's not much has been done, but in Western world, so much of money has been pumped into the system. There's a lot of money lying idle, which would be chasing gold. Inflation is going to go up. Commodity markets, I believe, would go up. Equity markets are going to go up, and that would lead to higher gold prices. It would be kind of a frenzy once everything gets back to normal.
Right. And that's a frenzy is a tricky word, but it's definitely a word I'm sure many potential investors are looking to hear or were happy to hear. On that note, Hiren, it was a pleasure talking to you. Thank you all who've joined in late in the evening to participate and for all your wonderful questions. And I do hope that you've got some insights that will help you take some very, very serious positions in this very interesting asset. Thank you all and good night.